Hello, everyone, and welcome to another episode. My name is Rufus Kamau, Markets Analyst at FX. We will be doing a very interesting episode today. We will be looking at the rise of the NASDAQ, and of course, we'll be looking at the underlying reason why everyone is looking and trading AI stocks. So, we have had some good developments happening in the artificial intelligence sector. And these developments has made an impressive rally, especially in the NASDAQ. So today, we'll be looking to understand why this has been happening and whether the opportunity is out or whether there's still more opportunity for some further upside. So a quick background, last year, we saw US equity indices trading downwards. They were in a bear market. So if you look at the S&P 500, you look at the NASDAQ as well as the Dow Jones, they were majorly losing for the year. But since the beginning of this year, we have seen some impressive recovery happening. And as a result of this recovery, we have seen some good growth in valuations. And some of the key highlights include some of the big stocks such as Apple, Amazon, Microsoft, NVIDIA, Tesla, and so on. So we'll be trying to understand what has been happening with these shares. And once we understand these, then hopefully we'll be more prepared to trade in the second half of the year. Remember, the first half of the year ends at the end of this week. So on the next half, we'll be trying to understand where to allocate our positions. So that being said, I think it's the right time to start this session officially. So just a moment. So I'm still waiting for more people to join so that we can proceed. So as I wait, let's get right into it. So I'll be starting with a number of key highlights. So we'll be looking at some of the stock valuations that have really made some impressive rally this year. Of course, the key highlight is NVIDIA. So as we all know, NVIDIA is a company that deals with the manufacturing of microchips. And these microchips are being used to basically run AI programs. So as we all know, the common saying that in a gold rush, it's the guys who normally sell shovels that make the most money. So as more and more people are looking at artificial intelligence stocks, there's also this idea that the companies that provide the necessary hardware that supports artificial intelligence are the ones that are benefiting the most. So that's why we have seen companies that are dealing with microchips having some of the most benefits. So for NVIDIA, it has really done well. So as you can see, for this year, that is since the first trading day of the week, that was on the 3rd of January, up to today, the stock is up a staggering 186.76%. So these are quite an impressive run. It's not every day that you get to experience this kind of growth in equities. So most of the times when you see investors going for stocks, their targets are usually way smaller or way lower. So if you look at the top indices like the S&P 500, the NASDAQ, the Dow Jones, they normally perform at an average of about 30%. So 30% is on a good year. On a bad year, you'll see 8-15%. So over the last, let's say 10-20 years, they have averaged around 13% for the S&P 500. The NASDAQ is usually higher because of the tech domination, and the Dow Jones is usually a little bit lower. So with this individual company being 186%, it's evidence that AI stocks are really doing some good work for investors. Apple usually does smaller numbers, but this year, since the beginning, it's up 51%. So if you look at Tesla, which is also very big in terms of AI applications. It's up 136.48%. If you look at Palantir, one of the top AI stocks, it's up 135%. If you look at Meta Platforms, this is the mother company that owns Facebook, Instagram, among other companies. It's up 128%. This is since the beginning of the year. If you look at Amazon, it's up 50%. So these are some of the tech behemoths. So if you also look at Microsoft, it's up 40%. And another key highlight company is Google. The mother company is Alphabet. As you can see, it's up 34% year to date. So if you keep on checking some of these stocks, AMD is up 70%. Of course, AMD is similar to NVIDIA in this case, mainly because it deals with the development and manufacturing of microchips. So being up over 70% since the beginning of the year, we can conclude to say that this is a bumper year. And of course, it's the best performance for the NASDAQ since the actually on record ever. So for the first half of the year performance, this is the best that the NASDAQ has ever done. So besides this, if you also look at other companies that are closely related to AI, an example is Shopify, which is up 81%. So per se, Shopify is an e-commerce platform. It doesn't own any AI products, but it's incorporating AI platforms to improve its product offerings and the services it offers. And as a result of this association, we have also seen the company make some really good run for this year, being up 81%. So we will be expecting more stocks to be performing really well. And of course, there's quite a number of factors to consider going forward. So that's why we are doing this presentation to see whether the opportunity still exists or if there's more to this story. So I have a very small slide here. So I'll be beginning by focusing on the NASDAQ 100 index as a beginning. So the NASDAQ 100 index is up 38.27% year to date. So for anyone who did not go into the rabbit hole of selecting individual stocks, but instead they decided to buy the entire index and bet that the entire NASDAQ will perform well this year, then their position is already up 38.27%, and this is quite an impressive rally. So over the last 20 years, there's only 5 times that the NASDAQ has rallied over that 5% in a year. I think it was the year 2003. We also saw the NASDAQ rally in 2009. That is right after the stock market crash of 2008. 2013 it had a pretty big run above 35%. And of course, after COVID in 2021 and 2022, 2020 and 2021, the NASDAQ made over that 5% before losing last year in 2022. So this year being only the first half of the year, January to June, up that 8%. This is quite impressive. And it's evidence that a lot of investors are betting on the future of AI. So we'll be looking to dive deeper and understand why this is happening. And once we understand, then hopefully we'll be able to identify opportunities going forward. So as you all know, these sessions are not investment advice, neither are they a recommendation to trade. So you should always do your own due diligence, do your own research, and of course, practice proper risk management. So going forward, there's a big factor that we need to consider today, and this is the factor of falling inflation. So since COVID started, that is in the year 2020 in March, one of the key things that we saw central banks doing is practicing what we call ultra easy monetary policy, which involves pumping a lot of dollars into the economies. So for the US, they printed a lot of dollars, way over $8 trillion. And this has had a very big impact in the markets. So we saw an impressive rally, and of course, the market making a V-shaped recovery. So after the panic that happened in March and April 2020, in May, the market had already begun recovering, and within 90 days, the market had recovered from the recession, and that was the fastest recession ever in history. So this money basically found itself in various asset classes, including stocks. We saw a very big rally happening in cryptocurrencies, and many other assets, including real estate. And when this happened, there was a big supply of money in the economy, which basically led to high inflation. So inflation began to rise towards the end of 2020. In 2021, it was rising even further. And towards the end of 2021, the central banks realized what they had done. They had created inflation in their own economies, both the ECB, that is the European Central Banks. There's, of course, the Federal Reserve Bank of the US, the Bank of Canada, Bank of England, and all these other major central banks. So they made a very quick turnaround, reduced all the quantitative easing they were doing, and started pulling this money out of their systems. And one of the ways they did is by cutting quantitative easing programs to zero. And after doing this, they started hiking interest rates. So by raising interest rates, they were doing this to address the rising inflation. So for the US, the first rate hike happened in March last year. So after implementing these, they kept on hiking interest rates. And as a result, inflation started going back downwards. So for US, since the inflation was rising, it managed to reach a high of 9.1%, and this was in June last year. And since then, we have seen inflation going down month over month. So from 9.1, we saw inflation annually dropping to 8.5, 8.3, 8.2, 7.7, 7.1, so 6.5, and at the beginning of this year in January, it was down to 6.4%. So the central banks kept hiking interest rates on each and every meeting, especially for the US Central Bank. So as a result, inflation kept going down to 6.4, 6, then 5%, 4.9, and in the most recent reading, it was reading at 4.0%. So the central bank target for the US is that inflation is optimal at 2%. Not many investors will agree with this, but that's what they always work with. So in this case, they are looking to get inflation back to the 2% target. So from the recent meetings by the US Federal Reserve Bank of the US members, they basically paused interest rates in the last meeting. So they held interest rates level at 5.25%. And they promised that if inflation shows resilience, then in this case, they could go for some further rate hikes and perhaps peak inflation at 5.75%. So this tightening cycle is what basically led to the bear market of last year. But then this year, the bear market in equities did not continue. So what we are seeing across board is investors betting that inflation will somehow drop to us 2% target. And of course, the Fed will be forced to hold interest rates and eventually look into cutting interest rates towards the end of the year. So when this happens, we know that investors will not wait until the Fed cuts interest rates. So in this case, the Fed will be showing some forward guidance on what they are looking to do, and investors will place their bets early. So we did not expect the stock markets to rally this much this year. So we basically saw a surprise run happening as a result of these AI stocks. So going forward, we will be expecting the AI craziness to keep on boosting the stock market rally. And it's important to look at some of the factors that are influencing these. And of course, we also look at the risk side to understand whether it's a dead cat bounce. Dead cat bounce basically implies a market rebounding, making a small rally before continuing with a bear market. So the first question is, why AI? Why artificial intelligence? So artificial intelligence is basically machine learning programs that are basically facilitating companies to process data faster and more cheaply. They are empowering companies to offer better services and, of course, faster services. And on top of these, they're enabling companies to deliver their products at much lower costs. So some of the applications of AI include self-driving vehicles. We have seen the chatbots, especially with ChatGPT. We have seen the applications in companies such as CRM, where clients are able to interact with the company without the need of intermediaries, such as customer service agents. So an AI is able to interact with clients 24 hours at much lower cost than hiring people to handle customer service. among many other applications, such as manufacturing and so on. So we have seen rapid advances in AI technology. So in recent years, there has been significant advances in AI tech, such as development of large language models. So when you talk of large language models, it's things such as ChatGPT. With Google, we have seen Bard and many other applications from the top companies. So we have also seen deep learning algorithms happening very quickly, and a lot more companies are taking these systems and incorporating them in their platforms. An example, we have seen the top social companies incorporating AI. This includes companies such as Twitter. We have seen YouTube doing the same, Google search doing the same, among many other companies. So these advances have made it possible for AI to be used in a wider range of applications, from facial recognition to natural language processing, as well as self-driving cars and medical diagnostics. So growing adoption of AI businesses. As AI technology has become more advanced, businesses have begun to adopt it at an increasing rate. So AI is being used in a wide range of industries, including healthcare, finance, retail, and manufacturing. And this adoption is driving demand for AI solutions, which is benefiting the companies that develop and sell these solutions. So if, for instance, you're looking into a company and it has been making some good earnings per share, and it has some good fundamentals, and then there's news that the company is adopting an AI application to improve their product or service, then this basically helps lower the company's overheads or expenses while increasing the productivity of such a company. And this makes it even more attractive. So that's why we have been seeing this craziness happening this year. And as a result, we have seen a big boom in NASDAQ 100 equities. So there's also what we call increased investments in AI. So sometimes as an investor, you want to know where the money is going. So if a lot of money is finding itself in AI companies, then you might want to follow that route. So the growing interest in AI has led to increased investments in the sector. Venture capitalists and other investors are pouring money into AI startups and established companies. So this investment is helping to fuel the development of new AI technologies and, of course, applications. So I remember back in the COVID days, we saw a lot of money flowing in several industries. There was a lot of money going into crypto startup companies, which really did well. We saw a lot of money flowing into video streaming companies as well as cloud services. So that's when we saw Microsoft making an impressive run. Zoom video applications was one of the top winners in 2020. And of course, a lot more money went into healthcare companies that were dealing in the manufacturing of vaccines. So if you followed the money, looked at where investors are focusing their energy, then you could have made a big bet at that particular time. So last year, when we were having a bear market, a lot of money was flowing towards a commodity side. So we saw a lot of investors, as well as investment banks, pumping their money into energy companies. So that's why the top performing sector in the S&P 500 was the energy sector. Companies such as Occidental Petroleum were up over 100% for the year. Other companies such as Marathon Group were really doing well. So once you understand where the money is headed, it's easy to make an investment decision. So far, as per now this year, a majority of the money is finding itself into AI stocks. So there's also positive sentiment towards AI. Investors are generally bullish on the future of AI. They believe that AI has the potential to revolutionize many industries and create significant economic value. So this positive sentiment is contributing to rally in AI stocks. So next part, we'll be looking at the factors for AI. Why is it that a lot of investors are favoring these investments in AI? So one thing to consider first is the COVID-19 pandemic accelerated the adoption of AI. We know that it was the first vaccine that was fast-tracked using artificial intelligence. Most other vaccines in the past have taken a lot of years to develop and implement, but this one was developed within a record year. So among many other things that were done using AI, they boosted confidence in these investments. So the pandemic has forced businesses to adopt new ways of working. Of course, if you are currently working in a business environment, a corporate environment, or even a government institutions, you have seen key changes happening in the way people work. For instance, right now as you speak, I'm working from home, and previously we would find that most of our working arrangements would be happening from the office. So out of working systems have shifted into either working from home, hybrid systems, and so on. And this has created high demand for crowd applications that enable big teams to interact with each other despite being in remote locations. So we have also seen AI chatbots, which have been used to provide customer service. So for instance, I think with Safaricom, we have Zuri, where you're able to interact with Safaricom company without the need of interacting with a different person. We have seen AI-powered contact tracing applications, which have been used to track the spread of the virus and so on. So the increasing availability of data is fueling the development of AI. AI algorithms require large amounts of data to train, and the amount of data that is available is growing exponentially. So this is enabling the development of more sophisticated AI models that can solve a wider range of problems. So the growing number of AI startups is driving in innovation. So if right now you are looking to invest into a startup company, then if that company is building on top of AI, it has a big edge compared to other kinds of startups. So there are now thousands of AI startups around the world, and they are constantly developing new and innovative AI solutions. And this competition is forcing established companies to invest in AI also in order to stay ahead of the curve. So I remember when ChatGPT was introduced in December last year, it gained very fast popularity, and by the first 3 months of the year, it had hit 100 million daily active users, and people started speculating that it's going to replace Google. So as a result, Google made a huge investment in AI, and as a result of that, we are seeing even more companies investing in AI in order to preserve their winning edge. So this is leading to higher innovation, higher budgets for research and development. And as a result, we will be expecting to see further growth. So I've seen several articles online basically saying that AI is the second coming of software. So the increasing demand for AI talent is also driving up valuations. So for most, let's say, developers who have been working on other applications, they're now shifting and increasing the investments in AI. And as a result, we are seeing more companies hiring AI staff. Apologies for this. So there's a shortage of AI talent, and this is driving up valuations for AI companies. This is because companies are willing to pay a premium for companies that have the expertise to develop and deploy AI solutions. So those are some of the factors that have been happening and being positive or pro AI investments. So with this in mind, I would like us to look at a couple of articles that have been checking out. So one of them will be focusing on risk. So I'll be looking at some of the risks to consider before investing in AI companies, as well as AI products. So the first things to consider is rising interest rates. So we all know the effect of rising interest rates. So whenever there is high interest rates in an economy, one thing is clear, the existing loans become expensive. So companies that normally operate on heavy debt, they realize that they're spending most of their money paying that debt, and they have less money left to invest. So in this case, it takes a big toll on companies when interest rates are moving higher. So as for fresh borrowing, we know that interest rates will go up with commercial banks, and this normally discourages borrowing. So if you have a AI investment opportunity or venture, and let's say it has a projected, let's say growth of 6% in a year, and interest rates are rising towards 6%, then you know that breaking even is going to be a little bit harder. So with high interest rates, it's way harder for new venture firms to be profitable. So this discourages them from borrowing to invest in AI applications. So the fact that interest rates are keeping on rising, it becomes quite a big problem. So before this interest rate hiking cycle started, interest rates in the US were very close to zero at around 0.1%. But now they have risen to 5.25%, and the central bank governor is promising even more. And this is discouraging a lot of investments. So it's a critical risk to consider, though there's speculations that the Fed will not go beyond 5.75%. So the Federal Reserve raised interest rates by 500 basis points in the past 15 months, and this is the steepest charge in 4 decades to tame historically high inflation. So benchmark rates in the US are currently the highest since the year 2007. And of course, we know what happened when interest rates were last this high. There was a stock market crash, and that risk is still very pertinent today. So, and while the Fed has succeeded in lowering inflation significantly and left rates unchanged in the last 1 month, the Fed still signaled 2 more rate hikes, each 25 basis points, and this is by the end of the year. So the annual pace of consumer price increases has fallen to 4% from the last year's peak of 9.1%, but still remains twice the central bank's target of 2%. So this could aggravate the risk of an economic downturn. So the risk of a US recession is very real this year, and that would be very bad for AI investments. And this has been highlighted already by various investment banks as well as market experts. So higher borrowing costs have already hurt interest rates sensitive sectors of the US economy, including the banking industry and of course the commercial real estate market. So some investors are worried that the US stocks are next in line to suffer if the Fed continues to tighten policy, and this has encouraged short sellers to bet more than $1 trillion against US equities, despite their current bull run. So what this basically means is that there are a lot of hedge funds as well as investment banks are on the short side of the market. They are betting that the market will go down, and these bets are increasing by the day. So the fact that we have really high valuations happening in these stocks basically means that there is a good chance we will be seeing some form of correction happening. And out of investors know this, and they have been betting on this. So this was the highest price ever for the US 500 or the S&P 500 index. And of course, for the NASDAQ 100, this was the highest price ever. So last year, January prices were going down, and now this year, you can see the impressive recovery, and we are almost getting back to all-time highs. However, when this was happening, this crazy run in 2020, this was the shortest recession here, market continued rising, and 2021 continued running. During this period, there was a lot of easy monetary policy. The US was just pumping more money into the economic system. But now there's no quantitative easing happening. So this year's rally has happened without any form of quantitative easing. Interest rates were really low when this was happening. They were close to zero at 0.1%. But now this is happening when interest rates are at 5% and inflation is still high. So this begs the question of whether this is sustainable or whether it's short-lived and the market will eventually fall back downwards. So we are currently testing a high that we saw last year in March. And if we break here, then we'll be looking at January prices of last year. So this creates a significant risk, and that's why a lot of hedge funds as well as investment banks have made a very huge bet of over $1 trillion that the market will eventually correct to the downside. So that's the first thing to consider in terms of risks that could be there if you go for a continuation of this rally. So according to the Fed itself, its recession probability model shows there's a 70% chance the US economy will experience an economic downturn by May next year. So the fact that the Fed or the central bank of the US is betting that there will be a recession before May 2024 is something to consider, especially knowing that interest rate hikes tend to have a lagging effect on the economy. So if the Fed hikes interest rates today, then that effect could take at least a year to have the full impact on the economy. So since we have had over about 10 consecutive rate hikes since March last year, then it basically means that we have not seen the full effect of these rate hikes, and the recession could be somewhere very close to the current date. So That could even put a dent in AI hype, according to Oanda senior market analyst Kevin Wong. So overall, a higher for longer interest rate environment is likely to further increase the cost of funding, coupled with an impending global recession that may put downside pressure on corporates' profit margins. And this was a response on a newsletter. So the second one that we need to consider is commercial real estate trouble. We know that there is a commercial real estate crisis that is currently boiling in the US, where the high interest rates have made mortgages really expensive for the average American, and of course for the average American corporate. So for companies that really invested in commercial real estate, when there was easy monetary policy in 2020 through 2021, those loans have become really expensive. They didn't expect that interest rates would suddenly run from 0.1% to over 5% within a year. And this has led to more pressure, and risks of defaults are currently rising. And we have seen tens of billions of dollars worth of assets slipping into distressed territory, meaning that there's a high probability of defaulting by these borrowers. So the amount of troubled commercial real estate assets, meaning properties that are forced to be sold as owners cannot afford to pay their mortgages, jumped by 10% in the first quarter to about $64 billion. And this is as per the MSCI Real Assets report. So another 155 billion of assets may be at risk of turning bad, according to the outlet. So commercial real estate mortgage delinquencies rose to 3% in the first 3 months of 2023, and this is according to the Mortgage Bankers Association. So US commercial property owners have struggled over the past year as steep interest rate increases by the Fed aimed at cooling inflation chipped away at the ability to meet mortgage payments. At the same time, tightening credit conditions and work from home trends are adding pressure to the industry. So we know that before COVID, there was a lot of people working, especially in the commercial real estate sector. So demand for commercial real estate was really high. But now, after COVID, there's more and more people who are willing to work from home. A lot of industry trends have shifted, which has led to lower demand for commercial real estate. So this is happening world over, including in Nairobi. You notice that there is less demand for office space in Nairobi, since a lot of people are majorly working from home, where they would have otherwise worked from these offices. So as a result, the valuations for these properties have really gone down. And of course, the people who took loans betting that there would be occupation, they are seeing much lower occupation. And those guys who took loans are bound to default or enter a distressed territory. So it has sparked widespread concern that commercial property could be the next industry to slip into turmoil, following the banking sector chaos of recent months, where we basically saw Silicon Valley Bank collapsing, and of course many other banks, including the Swiss bank, that is Credit Suisse. So there's also the other factor of China's economic slowdown. So China had made an impressive run after reducing or removing all COVID-19 restrictions. This started in December last year, and in January, there was all kinds of investors going for Chinese tech stocks. So they made some good recovery, but now in the second quarter of the year, we have seen some good weakness happening in the manufacturing sector, as well as in the tech sector. And this is basically a slowdown that has prompted the People's Bank of China to cut interest rates. This has led to lower bets on the recovery of China. So the US economy is grappling with internal economic problems. It also faces external risks, and this is predominantly slowing growth in China. So after years of lockdown under Beijing's strict zero COVID policy, economists were hopeful that the Asian economy would experience a strong rebound after it reopened this year, but that's very far from what has actually happened. So an insider's Lynette Lopez reports, China's economy is in more trouble than anyone thought, with trade slowing down, weak industrial production numbers, and piling debt. And that's a problem for Wall Street because, of course, we know that China has always been a huge market for US companies. So those are some of the key things to consider when you look to invest in US, the AI boom that is currently happening right now. So with this in mind, let us look at some more angles to the story. And of course, if you have any questions, feel free to type them in the comment section and I'll be responding to that right away. So one of the key flag bearers or one of the top leading companies in the AI sector is NVIDIA. We know it's dealing with manufacturing of microchip components that are very important for data servers that are used for AI. So on June 26, and this is basically last week, Oakland, California, June 26. Snowflake, we all know Snowflake, it's a cloud data analytics company, entered into a partnership with NVIDIA to allow their customers ranging from financial institutions to healthcare and retail to build AI models using their own data. So the two companies announced the partnership at Snowflake Summit on 2023 on Monday. So in the old days, in small data computing, you moved data to the computer. NVIDIA Chief Executive Jensen Huang told Reuters. But when you have giant amounts of data like Snowflake does, and the pile of proprietary data that's so valuable to a company, then you move the compute to the data. So in this case, NVIDIA is taking a very engineering intensive move of embedding its NeMo platform for training and running generative AI models into the Snowflake data cloud, said Huang. So we are seeing more expansion happening with individual companies such as NVIDIA. So while we might look at the risks that I've just mentioned, such as the risk of recession, high interest rates, slowdown in the Chinese economy, US commercial real estate, individual companies are making big strides into making sure that they establish their ground in the AI revolution. So while there are those risks, there's still a chance that some of these companies will continue to grow and expand, and we've already seen it happening with NVIDIA. So it has also happened with Microsoft, which invested over $10 billion into the AI platform OpenAI, which is basically the company that owns and runs the ChatGPT platform. So the partnership comes as ChatGPT has pushed many companies to find their AI strategies, and it has propelled NVIDIA, which provides the main hardware for AI, to becoming a $1 trillion company. So this is significant. This is the last mile that we have been waiting for 40 years, said Frank Slootman, chairman and CEO of Snowflake. So every industry is on this. They used to say software is eating the world. Well, now data is eating software. So I have a couple of more articles I would like us to highlight and go through before we get to the end of the presentation. So investor excitement over the rise of AI may be obscuring some serious risks facing the US economy today. I think we have already gone through this. So the other one is here, AI stocks frying, but don't call the craze a bubble. It's not a bubble. So the rapid rise of generative AI has created a frenzy on Wall Street, but investors and strategists say the rush to profit from the new technology isn't necessarily a bubble. So of course, in the early days of this year, we have seen people comparing the rally in AI stocks to what happened in 2021, when we had the Reddit stocks crazy happening, where companies such as GameStop, which were fundamentally weak, are making some very good returns within a short period of time. We had seen rallies happening in companies such as Bed Bath and Beyond, GameStop, among many other companies. But now we are seeing very solid companies making an impressive run. And while this may not be sustainable on the long run, maybe there's still some Momo trades to be found, or basically momentum trades. So investors are piling into shares of big tech companies such as NVIDIA that are perceived to be leading in the nascent field. They are pumping cash into private startups working on generative AI or systems that can conjure human-like conversation and imagery and generate computer code. For instance, I think the latest that we have seen is an image generative AI program being incorporated to Adobe's Photoshop, and this has led to a rally in Adobe shares. So if we look at a quick search of Adobe stock, you notice the same. sorry. So this is Adobe Incorporated. So right after they basically introduced an AI product to their platform, this was last month. So you can see in June, there was a big spike in the company valuation, and now it's up 44% year to date. So that's a key consideration that the stock was largely moving sideways. They introduced an AI product, and now the stock is up 44%. So it's a clear path showing that investors are betting big on any company that goes on the AI route. So the AI application, ChatGPT, reached 100 million downloads in just 2 months, much faster than other popular apps such as TikTok as well as Uber. So the rapid growth of technology has caught the attention of lawmakers in Washington, who have begun a bipartisan push towards establishing new regulations. So this is another key thing to consider, that the US Congress is looking to create new regulations for AI applications, and maybe this could hamper or stop at the speed of the innovation that's currently happening in the space. So the fact that we are seeing more regulation being brought to the AI, this could stop the rapid pace upon which you've been seeing AI growing. So a very good point to reflect on is that crypto companies, especially exchanges, made some very good run during COVID. And now we have seen the US regulators creating new regulations and clamping down on these exchanges. And since the lawsuits started happening on companies such as Binance, Crypto.com, as well as Coinbase, those stocks have really slowed down from the rally that they had a couple of years ago. So when you see more regulators clamping down on these companies, then it tends to have a negative effect. So it's also another risk that you need to consider, whether the AI regulations will be negative for the company or whether they'll be positive for the company, and how this goes forward. So investors are extremely interested in this space, even in light of questionable economic data and challenges in equity as well as fixed income markets. So the interest has led to the dramatic outperformance in big tech shares. NVIDIA, which makes chips needed to power the technology, unveiled a sales and profit forecast that blew past Wall Street expectations. So on Thursday last week, the RE added nearly $200 billion to its market capitalization, putting it in striking distance of $1 trillion. So eventually the company got to $1 trillion valuation, and this was big news in the markets. So going forward, we'll be expecting more stuff to be happening. And since you have looked at the opportunity as well as the risks involved, it's time now we look at the NASDAQ 100 index, look at the stock chart, and once we understand what has been happening, perhaps try and speculate where it could be headed next. So the fact that more and more investors are pumping more money into AI equities, and these equities are the dominant companies in the NASDAQ 100 index, then there's a good chance that this rally is not yet over. So last week was the first bearish week in about 8 weeks in the NASDAQ. So if you look at 1, 2, 3, 4, 5, 6, 7, and this is the 8th one. So in 8 straight weeks, we have seen the NASDAQ continue to rally. So last week was the first time we saw the NASDAQ going downwards. So this week, you can already see the market starting bearish and dropping fast on Monday. On Tuesday, we saw a reversal of the same. And today, we have had a nice break of this particular trend line that was quite worrying for the bulls in the market. So in this case, what we have seen is the market breaking this particular trend line and moving up higher. So if I was to remove these trend lines here and make it a little bit clearer, then we can see that there was a very nice break here. The market pulled back, and now there's a good chance we'll be seeing some further upside happening in the NASDAQ 100 index. So the immediate target for a short-term trader would be the most recent high of 15,287. So there is a good chance we'll be seeing the NASDAQ continue to push and get to the previous high. And this is 15,227. And if we breach that high, then we could even move higher. So sorry, trying to identify the right price here. This 50,284. This is the most recent high here. So there is a good chance that after seeing the break of this particular pattern, which is a bearish channel, then there will be a run towards the top of the pattern. And of course, the top of the pattern is right here at 15,284. So it might make sense to look for more bullish position from this point going onwards. So less tech-dominated equities include the S&P 500. It's also making an impressive rally. It has also broken the upper trend line yesterday. So traded sideways for the day, but there's a good chance we'll be seeing some further upside happening going forward. So if the S&P 500 makes an impressive rally towards the previous high, then the target would be on the last 2 weeks high of 4,448. So that would be a nice target. But for the industrial dominated Dow Jones index, I don't think we'll be seeing such a strong rally happening here, since a majority of the Dow Jones 30 index companies are not in the AI sector. So this might not make a rally equivalent to the previous two indices. So as you can see, the Dow Jones has been moving sideways for the last couple of months. So I would say for the last 7 months, the Dow Jones index has just been moving sideways. So right from January of this year, it's just a sideways momentum. And of course, December was also sideways. So the last time we had a straightforward trending month, it was October, November last year. So right now, I wouldn't be so impressed with the Dow Jones, but the S&P 500 could be having some upside potential, whereas the NASDAQ seems to be having the most upward potential among the top 3 indices. So it's a major resistance level that we last saw here on March last year, and of course, in February last year. So now that the market is retesting the area again, we could be seeing the market form another top here before we consider whether we'll be going back downwards or even higher. So for now, my overall personal thesis is that there's a good chance we'll be seeing the NASDAQ make an impressive rally here. And once it gets here, we observe whether there's a break. If the break happens, then perhaps we trade even higher. So that's it for the day. Thank you very much, everyone. And I hope to see you guys on the next session. So hopefully we'll have reached those levels and everyone will have benefited from the session. So thank you guys. See you on the next one.